And so as we look at what's going on in China, it's clear that the economy began to slow there.
China is, by some measures, already the world's biggest economy. It doesn't just make stuff these days, it buys stuff. Early last year, GM sold 30% more cars in China than it did in the U.S. Starbucks was opening up a new store there every 15 hours. But over the past 6 months, experts have noticed a major shift.
We're seeing weakness in the consumer sector, we're seeing weakness in manufacturing activity, and weakness when it comes to general business investment as well. And the breadth of that weakness across all of these sectors means that it's not an isolated incident. This really is an economy that's slowing down faster than we would have expected.
Why? Well, some point to the trade war between the U.S. and China.
By placing tariffs on foreign imports of steel and aluminum.
Tit-for-tat tariffs have taken a bit of a bite, but the roots of China's slowdown may be deeper.
To me, this is really just a cut on top of an already broken arm. China is really moving from a manufacturing, industrial-based economy to a consumer-based economy.
That transition means the kind of sedate growth you see in developed economies. In fact, Beijing has been trying to engineer the transition, for example, by tapping the brakes on credit.
We know that China is going to slow over the long run, but what we're hoping is that it's a smooth transition. And if we see economic numbers like we did this week out of China, the concern is that it's not smooth at all. It's a bumpy ride and maybe one that we're going a little too quickly down.
So it's easy to see how bad Apple results have rippled through markets around the world. If Chinese growth hits a wall, everyone will feel it. And eyes will be on not just Washington, but Beijing to see what they do next.